Welcome back. You're watching Stock Picks, and today we unpack ABSA, TFG, and BYD with Faheema Adia from Momentum Securities. Faheema, thank you so much for being with us today, and a happy New Year to you.
Afternoon, Alatando. Thanks for having me. Happy New Year to you too.
Fantastic. Faheema, I think before we get into the stocks, is there a reason why you've chosen these counters?
Yes, so if I can just give you a brief summary of each and why I chose them. So if we look at BYD, that's China's largest electric vehicle manufacturer, and it's quite a big competitor to Tesla. It's been taking quite a lot of market share from Tesla in China and other parts of the world over the past few years. That can be attributed to its market range and more affordable cars, which give consumers more choice. If we look at TFG, what we like about TFG is that it has diversity of revenue and earnings due to its exposure to other geographies such as the UK and Australia, which we think is quite beneficial given, the constrained SA macro backdrop and the consumer that's been under a lot of pressure. We're also expecting to see an improvement in the retail sector in South Africa later this year once inflation and interest rates hopefully come off further in the second half of the year. And then moving on to ABSA, we just think at the current price, it's pretty well placed to benefit from the upcoming rate cutting cycle, also on a pretty healthy dividend yield of about 8.5%. So I think if you compare the valuation of it to the likes of FirstRand, Standard Bank, it's at a much lower forward PE and definitely looks attractive from a valuation point of view.
I heard you mentioning, the amount of interest rates. Faheema, I'm keen to get your thoughts on just the themes that we are expecting to dominate 2024. Inflation was a huge one in 2023. Can we anticipate the same thing being on inflation watch?
Yes, so I think we're looking to take signals here from what's going to happen in the US because, of course, that drives other parts of the world and will no doubt have an impact on South Africa as well. So the market initially was anticipating rate cuts by March, but it seems that inflation could be a bit more stickier than what we initially anticipated. The latest labor figures that have come out from the US shows that the labor market is still quite strong there, and wage inflation is still on the rise. So from that point of view, I think inflation could very well be stickier than expected, and we might only look at the rate cuts coming through in the second half of the year. And I think that will, obviously have an impact on the SA outlook as well in terms of interest rate cuts. For now, we're not expecting any immediate cuts to interest rates. I think we still have a bit of concern over inflation levels in SA, and it does need to come off a bit further. We've also recently had things like, the rand weakening, which and if the oil price does go up due to the Middle East conflict, that could also then have other impacts on inflation. So for now, we're not expecting any interest rate cuts, but hopefully in the second half of the year. Yeah.
I think that segues perfectly into our first stock. Let's look at ABSA. This is one of our big five banks here. And you've mentioned that, they're well placed for the interest rate cutting cycle. But they've also really done well, with the endowment effect. In fact, it looks like ABSA has managed their impairments really well. And I think that's an important part of looking at these banks when trying to compare them, how they've managed impairments.
Yes, 100%, Alatando. So I think from that point of view, they've been, they've obviously seen their credit loss ratio at the upper point of the range, but that's quite normal. And it's the same thing we've seen with other banks, given that the consumer is under increased levels of pressure. But they've managed to keep it, I think, within a decent range if we look at the impairments, given the extreme headwinds that we're facing. And like I said, hopefully, once inflation does come off later in the year, and interest rates are cut, that would mean that there will be less pressure on the SA consumer, and then we should see some recovery in the credit loss ratio and also in the impairments there for banks such as ABSA. So I think the outlook for banks this year in South Africa in the second half is definitely favorable.
I must also ask you, with the higher for longer interest rates here, Faheema, is it likely that we see consumers losing, their resilience along the way, initially keeping up with payments, keeping up with the credit card, keeping up with the car payments, but as, this interest rates remain higher for longer, and now we're speaking about cutting possibly in July, I even heard August being thrown around here. Is it possible that the banks may see a little bit of more of impairments and credit losses here because consumers are really running out of cash?
Yeah, 100%. So I think so the thing is with banks like Absa and your blue chip banks, they kind of are a bit more conservative in terms of the consumers that they would extend loans to and credit to, and I think that would range more around the mid to upper income consumer. So we're not expected to see too much strain come for these type of banks. But if you look at the likes of Capitec, that have more of a low income consumer, definitely expecting to see impairments go up for those type of banks, because I think in this type of environment, unfortunately, it's the poorest that suffer the most when you do see inflation go up and these interest rates go up like this. But I think the banks like Absa, First Rand, Standard Bank, they would probably be a bit more resilient to those type of things because of the type of consumer that they would extend credit to.
I'd like to stay in South Africa with a TFG. Now, I think TFG is what I could call a bit of a comeback kid. They really have managed to come online with a strategy, that localization strategy, really benefiting them, for him at a time when many manufacturers of various products say it's not profitable to manufacture here at home. They seem to have clocked this.
Yeah, and actually, I think it's been a great time because given all those port issues at Durban Port, we saw actually recently that a lot of retailers that have been importing from the likes of China struggle to actually get their stock. So if you look at Woolies, for example, I saw in the trading update that they didn't manage to get their full range, and that obviously had an impact on sales. So I think TFG was definitely ahead of the curve here in terms of making sure they do have like a local supplier presence so that they could alleviate some of those issues that came about with the port constraints. And like you said, they've also got a really great online presence. And one thing I took note of is, Amazon is going to be entering the market, the SA market, quite soon, and they, of course, have a very strong online presence. And I think TFG, from all the retailers, has probably invested the most in terms of their online presence. So we think they should be pretty well positioned to compete with the likes of Amazon due to that.
Another interesting aspect, I think you mentioned it earlier, Faheema, is the issue of cash sales versus credit sales and the meticulous management. For instance, we have Mr. Price on one end with cash, sales there. We have maybe Truworths on the other end with more than 50% of their sales being credit. Fortunately, kind of in the middle here and really striking an intricate balance. I'm wondering if that could be the sweet spot.
Yeah, so I think in comparison to the likes of Truworths, TFG definitely has more cash sales. They've actually been quite cautious in terms of extending credit sales due to the very tough macro backdrop. So I do think, that is a good position for them to be in at the moment. You don't really want to be extending too much credit to consumers in this type of an environment. And, we see the likes of retailers like Truworths struggling due to that. So it is quite positive that TFG has more of a cash focus. And I think the business will be a lot more resilient because of that in these tough times.
Also, just staying with this one, Faheema, Shein. This is a very interesting, I think, competition for retailers all over the world. I think just reading about it and its impact in China and the US, everyone really trying to keep up with Shein. And I'm wondering, TFG here and their ability to compete with also the pace at which, Shein responds to trends there. Do you think that TFG will be fine as Shein grows? There's plans there to list, and it also looks like no government is kind of regulating Shein too much. Yes.
Yeah, look, in short, I think my answer is no, Nolatando. I think that Shein is extremely competitive, and the prices at which they are selling at is probably a third at what the likes of TFG is selling their products at. And I definitely think that the South African government has to step in to kind of control the prices at which Shein is selling to the South African market, because it's definitely going to become impossible for local retailers, I think, in the long term to compete with the likes of Shein when they're selling prices here at extremely, they're selling their goods here at extremely low prices. They've actually taken quite a lot of market share away from other retailers. I mean, a lot of South African consumers have been buying from Shein, and pretty large basket sizes. I actually read it's north of 1,000 rand.
Wow.
Which could be going to our local industry. So I do think it's going to be quite important for the South African government to intervene here and to put in some kind of, further tariffs or measures in place to just protect our local industry, or we are going to have quite a problem from Shein.
Before we move on from this one, Australia and UK for TFG, how is that faring? How big a part of the business is that? And is there room for growth in those territories?
Yeah, so I think the good thing is we saw some recovery there in Australia and the UK post-COVID, and there was better performance coming from there than in South Africa. So that's definitely provides some defensiveness to their earnings and their revenue given the tough SA backdrop. And I do think they will probably look to grow further in those type of markets, seeking further growth. I mean, if we look at South Africa, general growth for the country is just so low. I think it's probably at about 0.9% for this year, just about 1% for next year. So they do need to find more attractive growth markets in the long term. And I do think, TFG will have plans to expand further.
Now, speaking about growth, BYD, that's a fascinating story. They started off making phone batteries, but of course, big players in the EV market now. And I think they've even, they're giving Tesla, a run for it. And I'm keen to get just your thoughts here on the affordable EV market, because I think a lot of us are speaking about EVs as these expensive items. Many countries that are still, deep within internal combustion engines, wondering how they're going to really fix the pricing issue. BYD seems to have solved for this.
Yes, definitely. So I think that's probably the edge they have gotten over Tesla in the past few years. So Tesla did have a leading position in China a couple of years ago, but that's definitely changed. We now have BYD that has taken over. And like you said, they've just made affordable EV vehicles available to the public, and the public likes this because there's just more choice. I see they've also recently now introduced a luxury range of vehicles. So I guess, just having more choice is always better. And the good thing for BYD is that they also have certain cost advantages in comparison to the likes of Tesla. They're able to mass produce some of their batteries that they use in their cars. They also have some technological advantages. So on a cost basis, they're also better off when it comes to Tesla. And they've got huge plans to actually grow and expand the business into international markets over the next few years. So they've already got a presence in Thailand, Australia, Europe, also looking to build factories in Brazil, Thailand, and Indonesia. So a lot of growth expected to come from there. And we're also expecting to see an improvement in their profit margins. So definitely a very good growth story.
What we've seen actually, Tesla trying to respond to BYD is them decreasing prices of vehicles, in that Chinese market. But one thing I'm keen to find out here is whether Africa seems like a viable option for these companies. I mean, it's a great growth market, but of course we might be lagging behind with certain infrastructure. And even when we speak of Tesla moving into Africa, I think Elon Musk recently come out to say it's not worth it. BYD also, no plans on the horizon here. Are people sleeping on Africa?
So the main problem with Africa, Noluthando, is from an EV vehicle point of view, we actually have very high import tariffs that have deliberately been put in place for electric vehicles, in particular to protect our local, fossil fuel manufacturers in the country. So that's been a deliberate move by the government to try and protect our local industry. But of course, and basically that alone just makes it just uncompetitive to basically bring the likes of Tesla and even BYD's electric vehicles into South Africa, because it would just be simply unaffordable when you add on those extra taxes and tariffs that the government will charge. So in the long term, obviously, I mean, we do need to decarbonize. So there will be a point where we will need to start looking at either manufacturing electric vehicles locally or reducing some of those tariffs to make it possible for the likes of, Tesla and BYD to bring their vehicles into the country. But for now, that the main reason for that is basically just because of those import tariffs that are too high.
What we've also seen is the EU's enthusiasm in terms of just investigating anti-competitive behavior. And BYD, I think, is right now, right in the middle of an investigation with the EU trying to figure out if the Chinese government has assisted them and keeping their costs low and therefore able to roll out in Europe and at a pace that is kind of unnatural. I'm wondering if that could dent the share price, could dent the value. If it could just be a fine here that we see, and then they'd be able to move on, similar to what we've seen with the likes of Meta and even Google.
Yeah, so I think it just depends on the full outcome of that investigation. So if they are found to be, doing uncompetitive practices and their behavior has been uncompetitive, it just depends on the extremes that the government will take there. I mean, it could involve, until they correct their pricing, banning cars, BYD cars for sale in the country, or, a lighter measure, like you said, could be to just impose penalties or whatnot until they fix the pricing situation. But that's always a concern, I think, for countries all around the world, that they don't want to have Chinese companies come and dump their products in local markets at these discounted prices, and then that puts the local industries at risk and potentially out of business, which is basically what we just spoke about when it came to Shein and TFG and the other SA retailers. So it's good that their government, I think, is being more proactive, and we probably need to see something similar in our own country to provide more protection to our local industries.
With that said, Faheema, keen to get your rating of these counters. If there's a retail investor at home wondering how to allocate their funds here, in which order will you invest in these?
So I think the first one I would go with is TFG. Given this growth story and the expansion into other markets, electric vehicles are obviously going to play a very key role globally going forward due to the efforts to decarbonize the planet. Secondly, I would go with TFG. Like I said, we like TFG because of that diversity of revenue and earnings that come from other geographies, such as Australia, the UK. We're also expecting to see some further expansion there and hoping to see some recovery in the SA retail sector in the second half of the year. And then finally, ABSA. We think that ABSA in particular is quite undervalued at this pricing level, and will definitely benefit once we see those rate cuts come through in the second half of the year and once interest rates come off.
And with that said, moving into our educational term of the week, stock options. Talk to us about this.
Yeah, so a stock option is basically a form of a financial instrument known as a derivative. What a stock option does is it basically gives the holder the option but not the obligation to basically buy a share at a certain price or to sell a share at a certain price on a specified date. There are two types of options that we get. They're called call options. This gives the holder the right to buy the stock at the predetermined price and date. And then the other one we get is the put option, which gives the holder the right to sell the stock at a predetermined price and date. So it does cost a premium to buy the options, but it can definitely pay off in the long term, especially if the markets move in the direction that one expects. And the maximum that one would expect to lose on an option is the initial price paid for that option. So it is actually less risky than holding the actual stock.
Fantastic. Faheema, a pleasure. Thank you so much for joining us this afternoon on Stock Picks. That was Faheema Adia from Momentum Securities.